Hi, it's Frank Cappelleri from Cap Thesis. It's a pleasure to be with you here again on Stockcharts TV. So today we're going to go over three things: the S&P 500, the financial sector, and semiconductors, which of course is going to be on everyone's radar screen tomorrow after the close when Nvidia finally reports earnings. So let's start with the S&P 500 and specifically with the pattern work, which of course is the crux of our analysis here at Cap Thesis. And so as of about 2 o'clock here in New York on Tuesday, with about 2 hours to go to the closing bell, the S&P has been trying to fight its way back after breaking below what could be a bearish pattern. Now, this isn't exactly the most symmetrical head and shoulders pattern that we've seen. In fact, we probably shouldn't even label that, but I think the most important thing is we can identify the structure. The structure is that it's a topping formation, whatever you want to call it, with lower highs here and just failing to get back above this most recent high point, and then of course struggling to find any sort of direction really over the last month and a half. And so we've seen this a few times already. And so quite simply, if we get back above this zone near say 66.30 to 66.50, this will not be live. But if we do close below here, and we'll know by the time this video is aired that it could have a live bearish pattern. If this is the case, a measured move would take it down to right around 63.50, which would be over an 8% decline from the height of this, which of course is much more than anything we've seen up to this point. And so as things have progressed along the way, we of course haven't seen that downside break that is held, which means that the potential for a bullish formation to take shape instead continues to be with us. And we'll update this potential track every morning in our daily notes, and of course it's taking many different shapes so far. But quite simply, if we see a continued rally effort this time, which we haven't seen, but if we get some upside follow through after a big reversal, then we can see how this could take shape. Quite simply, the bigger the decline, the bigger the snapback, which creates a large bullish pattern, and that's what gives us those higher targets, right? Things that we've seen before. The last big target that we got, of course, was 67.45. And so again, we'll continue to keep this with us for as long as it's still a possibility. And so regardless if we look at the classical patterns or not, we can always categorize this price action in terms of trading boxes. Again, very simple strategy, very powerful though, because as you can tell, it's captured all of the action from the low here. And again, we know it's been like nonstop buying, but it's not exactly emphatic. That's really what consistent uptrends are like. We have, a few spots here, we have breakouts. So most of it is just consolidating those breakouts and then moving higher. We'll call these trading box breakouts, which we do, or just high level continuation patterns that could continue to get resolved higher. It just shows us that any pause along the way has eventually been healthy to the point where previously stretched conditions get digested and the market takes it from there. And so most recently, that's been difficult. And as we know, the ranges have increased a bit. As we can tell, this trading box, not exactly the longest, but definitely the largest in terms of height so far. And so again, trying to negate this downside break would be very important, because if not, it will be the first trading box breakdown we've seen, and that could constitute potential reversal pattern as well. And talking about unwinding a move that's almost 40%, with again, very little real support underneath, near term at least, to key off of, we can see how momentum can really get going on the downside. If not, then again, more consolidation. The longer it happens, the longer the S&P can hold in there in the face of all these different factors telling us that it should roll over, the better the chance it has to eventually break out once more and take advantage of what's supposed to be, seasonality-wise, a good month. And so short term, this is what it looks like, again, using a 2-hour chart, looking at the pullbacks along the way. And so we have two of them now, just over the last few weeks, that are both about 4%. Now we look at it like this because we know overall it's about a 5% move, but there's a big snapback in between, to the point where it started after seeing this 2-hour, 14 period RSI and the 2-hour chart get oversold. And we've seen this before in the past, and almost every time that has produced an overbought reading, it also produced new higher highs along the way. This time it did not. This was about 3.2% in advance, petered out before getting back to the prior highs, as the 14-period RSI only got to the low 60s. Meant, of course, that the advance wasn't as strong as we've seen before. And again, this is a short-term character change that we should take note of, especially if it ends up doing the same thing. Again, if it ends up failing to get back to overbought, if it fails again to make a higher high, that would tell us maybe momentum is rolling over. And that, of course, could keep the trading environment challenging, to say the least. If that means that we finally get a MACD sell signal that plays out. I've shown this chart before, and up to this point, we've had 9 prior sell signals, each one of them, of course, not working out, just providing whipsaws, but very instructive because it's telling us that people are still there buying each and every dip. Now, this time, it's been with us a little longer, and it continues to be oversold, or it continues to be in sell mode, as we can tell from here. This is around November 4th, and even though we got that rally, right, over the last 2 weeks, it was short-lived to the point where the MACD, to the point where the faster black line here did not overtake the red line. So this is still in sell mode. So this could still work out. So it has a little leeway to work with here, and the structure of these lines won't change. And so again, just like the short-term work, we finally get some downside follow-through. It would tell us that it would be similar to this, right? What happened in December last year, or of course, the worst case scenario, it ends up playing out like we saw from February to April, right? Just something to keep in mind, because if this starts to work, it would tell us maybe that buyers now are getting impatient, they aren't getting rewarded as instantly as they have before, and that would just cause some steadiness, maybe employing some stop losses, profit taking, or just staying on the sidelines, not supporting it with the bids that the market has needed all along the way. And so sticking with the theme of some character changes, we've seen it now in the GoNoGo chart as well. Now, again, this has been decidedly bullish ever since mid-May, and it's been with us the whole time. Even as the market has flirted with potential topping patterns, this has not wavered until now. As we can tell, we've had 2 bars now that are amber color, meaning that this can be an inflection point, meaning that the trend has gone from bullish to slightly less bullish with the light green, and now neutral. So neutral, of course, can then lead to a change of character, right? We saw it here on the rebound. It finally turned from bearish to neutral for about 5 days and then flipped to bullish, and off we went. And so this, again, could get whipsawed. We've seen it before. Sometimes when the market is just digesting things in a more volatile fashion like it has been, it may just find a bid, and this can turn back to bullish. But we have to remember, too, that we're coming off of this really strong rally. At the same time, this produced what's called a squeeze here. And so that just means that it was a period of low volatility which caused this. And when that happens, it typically leads to a bigger move in either direction. Now, the last time we saw this and really worked out, of course, was here in February, March. But what I think is more interesting is what happened in December. Remember, market was making new highs. The breadth was terrible, 14 straight negative breadth days to start the month. That eventually caused some indigestion at the very least. But as we know, when the first time this went to, say, neutral, after a number of months of staying consistently bullish, it did change things. Now, we know the S&P regrouped, hit a new high that was brief, and of course, led to another consolidation, more head fakes on the upside, more failed bullish patterns, and then the bottom fell out. Again, worst case scenario, but I wanted to show this as a process. And when things change like this, it's not sometimes all right away. It just shows we know the breadth has been weakening. We know some areas have been moving lower. This has finally been reflected in the go-no-go trend. So let's talk about the financials next. But first, if you like this kind of content, I urge you to check out Cap Notes, which is our free Substack newsletter, where we provide timely market commentary, trade ideas, and access to select premium content. You can see all of the pieces that we've put out recently, videos, snippets from our premium cap thesis, notes, and also some unlocked full issues as well. Sign up today and receive our 6-step trading process that powers winning chart trades and limits losses. This is a simple, proven framework for spotting high probability setups. Again, it's capnotes.substack.com. See you there soon. All right, so looking at the financials, of course, very important because, well, they're the financials, right? They're important to both the economy and the market because let's not forget, while technology is the number one weighted sector in the S&P 500, financials is number two. And so recently, again, hasn't done much at all over the last few months, but we can see how this can be a trading range, but also has the characteristics of a topping formation as well, with it testing this 51 area numerous times. And again, like Tuesday, at least momentarily breaking below this zone. And needless to say, there is no near-term support underneath this. So that could easily, be filled or at least partially filled. At the very least, it'll be difficult to pinpoint an area where buyers would come in until, of course, it's in support discovery mode and a new price point is then discovered. So I'm about to show you a chart which has a lot of lines on it. Could be considered a chart crime, but I wanted to show an indication of exactly what's been going on with the XLF over the last year and a half. And that has just been a lot of bullish patterns being formed, their targets being hit until, of course, March, when this most recent one failed. And of course, we had to deal with the ensuing avalanche of selling that happened. Now, again, as we talked about, the biggest declines produce the biggest patterns. And so we got that breakout finally back in June, which produced this huge target up near 77. Initially got that follow-through move in June, but then at that point, that's when things started to flatline. And from there, again, this is the bearish pattern we just talked about. But before that happened, there was another bullish formation. We can call this inverse head and shoulders pattern, which took shape above the 51 area, broke out for a few days, and then, of course, rolled over. So we can see how important this 51 zone is. It's basically the breakout area from the big bullish pattern and also the neckline of the potential bearish pattern we just talked about. And again, there's some support here, of course, but nothing over the last few months. And so needless to say, holding this area is very important, right? It prevents this topping formation from being completed, and it keeps this 77 target in play by having this bullish formation remain alive as well. And, it's obviously a lot of different components go into the XLF. Some of the biggest names are in the IAI Broker-Dealer Securities and Exchanges ETF. And talk about ping pong like action, right? Look how many times they tested resistance and support, and look how tight this trading range has been, again, since June. We saw that it rallied up until July, but really it's been the same range between the high 170s or the high 160s and the high 170s the entire time. So at some point, right, one of these areas is going to give way. But right now, it's just been about buying weakness and selling strength until proven otherwise. And again, this one as well, just barely over the last 2 days, pulled below support so far, has held. And so we can also look at this as maybe a potential bullish formation, not exactly a cup and handle, but this area being a little bit lower, but we can see maybe, if it comes back up here again, this could eventually turn into an inverse head and shoulders pattern or just a, high level consolidation, continuation pattern, or maybe even just a really long trading box, which probably is the best way to view this. But regardless, if the IAI can break out, then the XLF can avoid breaking down below the bearish pattern and vice versa. Now, another part of the financials, which is not exactly part of the XLF, but very important nonetheless, are regional banks. Of course, very sensitive to interest rates. And, we've seen the KRE come back little by little from the regional bank crisis in 2023 to the point where over here, again, a lot of lines here, but wanted to show just what was going on, but had potentially 3 bullish patterns building at once. And in July, it looked like we're getting close, right? Because it already broken above the small inverse head and shoulders pattern in green, then came up and completed the larger one in black and just had a few weeks of pushing through there. And then, of course, that got negated. So this is identified by the red box here. And that unfortunately, then has prevented this big, huge inverse head and shoulders pattern from being completed. And of course, we have a lot more to go before that happens. So that makes it very important to see what happens over the short term, because over the short term, this is an undeniable bearish head and shoulders pattern, with this 58, 57 zone being extremely important to hold, because just like the XLF, not much below it near term. And if that gives way, then just like the XLF, this will just be breaking below other bullish patterns. It just makes it much harder to think that something like this is going to play out. And if it does, it's just going to take much, much longer. So we can't really focus on this huge inverse head and shoulders pattern that has been building until this proves that it's not going to actually break lower. And of course, there's nothing to say that is going to happen yet. So far, it is holding. Okay, let's go to the semiconductors. Last but certainly not least. So let's look at this from a few different angles. Number one, trading boxes as well. Now we notice this one's a little bit different than the S&P 500 because it had a really strong move through the end of October, early November, which produced a small consolidation zone. And with that breaking down below it, there is in fact a trading box breakdown already in play, right? Again, because of the strong move that it couldn't hold on the way up here. And so as a result, it's moving sideways now over the last 2 weeks, forming another trading range or trading box. Needless to say, we do not want to see 2 straight trading box breakdowns that will just put a real dent into this uptrend, into this momentum, maybe flipping from bullish to neutral to eventually bearish. Another way to look at this, we showed this chart before, and we know that the pace changes along the way. Even if this uptrend is going to continue, it just can't continue in the same pace over and over again. And so now we've had a number of uptrend lines broken. As we can tell so far, right? So far, at least, that hasn't resulted in momentum shift yet. Now we're talking about 1, 2, 3, 4, 5, the 6th uptrend line being broken just over the last few days. And again, we talked about this being a box right here, right, on a daily chart. We could also look at this whole thing here as a bearish pattern, right? It could be a bearish head and shoulders formation, which of course would be not ideal to see that breakdown. And we know a lot, if not all of this, is relying upon the reaction we see for Nvidia, which so far has done a very good job hanging near its highs. Obviously looks similar to the SMH. Now lastly, if you go back all the way, this is the daily chart here, but it just shows all the times when the SMH was strong enough to produce an RSI reading above 80. Now, a few takeaways from this. Number one, it's rare. It's only happened 6 times. And one point here is that we're only looking at the first time it occurred as the market was rallying, right? It may have happened a few days along, we may have seen some clusters along the way, but the first time is important because we get to see how much follow through there was. Now, again, this is daily, so we can't exactly see what occurred over the next few sessions, but the bigger trends are what we care about. And so going back here, 2014, we can say that the market continued higher until having some indigestion later on in the year. So pretty good extension over the next few months. In 2017, as we know, market continued higher. SMH did as well until the vol implosion in 2018. In 2019, the market, including the SMH, did well, but there were 2 specific times during that year when it was a tech-led sell-off. That was in May and August. So that actually happened at the very beginning of that, with the SMH then pulling back in the middle of May. Happened again at the end of 2021, right? Not exactly at the top, but close. Needless to say, it was a sign of exhaustion. Again, 2024, right in July, right before things rolled over in August. And again, most recently here, which really didn't do much to SMH just yet. It's continued to move higher. So, we can extrapolate this out and say, well, maybe it's due at this point. Or maybe it's something similar to 2014 where it can continue to rally. Again, this is a very big picture, something to keep in the back of our minds as SMH continues to deal with these consolidation zones, these trading boxes, tries to stay above the most recent uptrend line. And all this is going to be important regardless of what Nvidia does, because it's going to be one day, it's going to be a big reaction. People are going to make all sort of interpretations from it. But going forward, whatever happens, we have to detect what the next pattern looks like. And if that can be digested in a healthy way, then the extensions we've seen in the SMH over the years can continue, vice versa. If those consolidation patterns start to get leveraged to the downside, we know how that feels as well. That's it for today. Talk to you again soon.